GDP. We all know that GDP, or simply economic growth, is necessary for home prices and rents to go up. So I am delighted to see that the consensus forecasts for 2021 GDP growth are the highest they have been in decades. Typical consensus forecasts have been in the 1.5% to 2% range for the last 10 years. So it's fabulous to see a number that's as high as 3.56%. And by the way, this number, this chart was made before recent upgrades. So numbers being increased, and I'll tell you a little bit more about that at the end of the presentation. I want to share new data from the last week with you, right? Of course, a lot of this 3.5% makes up for the negative growth from last year. You see that here. But hey, that's behind us. We took that hit, and we're happily going to take the rebound bounce that we see here in 2021. Wow, great number. And 2022, wow, another great number. But there's no such thing as something for nothing. So a lot of you are saying, hey, GDP growth grows up, Neil, so does that nasty hydra called inflation. Yes, I get that. Well, in 2020, last year, inflation was very muted, no challenges, right around 1.25%. In 2021, yes, you're right, the consensus forecast is for inflation to jump. It's going to jump up beyond 2%. The question, though, is why is that bad? For landlords, that's not all bad. While everything gets more expensive, salaries and rents rise faster when inflation is higher. So as long as inflation stays under 3%, and you can see from the screen, it's projected to, real estate investors are actually pretty happy. The third big trend indicator that you guys, the real estate investors, watch is unemployment. 2020 was, of course, completely off the charts, but 2021 should be a more reasonable number. Right? Now, let me be blunt. 6% is still a high rate of unemployment than anything we've had in 7 years. So it can be a drag on wages, drag on investment. That's why that $1.9 trillion stimulus package that came out just now has changed everything. And I'm going to show you new numbers regarding unemployment forecasts now that have been updated in the last couple of weeks. The last economic trend indicator is the direction of interest rates. As you know, the Fed cut its interest rates. They call it the Fed funds rate. They cut it to 0. And then they did something really unusual. For as far as I know, the Fed has never once offered long-term guidance on interest rates. But the pandemic, it was so potentially devastating that they made an exception. And they let the markets know that they're going to keep rates low for years. As a result, we've had the lowest mortgage rates in history for many months. They've ticked up a little bit. You can see that they've gone up there. So right now, March 23rd is the last time we updated this. They're up to 3.38%, still insanely low numbers compared to where we were a year and a half ago. Well, here's what the big dogs are saying. The one on the left in green, that's the rate today. Whoops, that should be 3.38. There are 6 agencies in the US that predict future rates, and their average is actually a delightful 3.03. So basically the consensus is rates are going to stay in that 3 to 3.5 range for the entire year. And that's absolutely fantastic for real estate investors, and especially when you connect that with the sort of 12 months we are about to have, and I'll tell you more about that. I'm going to tease you with it. But bottom line is, at 3%, investors can afford a 20% more expensive home than they could afford. And we've got an incredible amount of interest in real estate at this point in time, incredible amount of interest in single family. That's going to create a lot of renters as people get priced out of the market.